Good. All right, guys. So let's just have a look around the markets here and have a look at what's ahead of us and just reassess what happened yesterday. Quite an interesting session, I think, in many ways. But before we talk about that, let's just have a look at some of these daily charts. So looking at the S&P and the DAX on the top of the screenshot, and you know, this well, it's almost like an inverse correlation is playing out. Yesterday's session we saw upside for the S&P, downside for Europe, and it's just the bizarre world that we live in. You know, if you'd put these two charts in front of, well, anyone, and said, right, well, we had economic data yesterday telling us about the health and the strength of the US economy and the health and the strength of the European economy, and you know, equity prices in the US went up and equity prices in Europe went down. You know, what do you think the data was? And of course, the obvious track to fall into would have been to say, well, obviously the economic situation in the US is good, and in Europe it's bad. Good data in the US, bad data in Europe, except of course you'd be exactly wrong. And you had an upside push in the S&P, and I'll just talk about this before we look at the data, because it's quite important where we're at. I'm just going to actually click to a weekly chart, because here we are up above 2100 yet again, having bounced off 2000 a couple of weeks back. You know, here we are back up towards the top. Now, this is really important, I think. If you take just 2015 as a whole, we do have a downtrend. We have lower highs as we've gone through this year, tracking down off this May all-time top 2134, and we're right here. I mean, I'd say roughly we're anywhere around, so 2106 is this trend line resistance. I mean, definitely, let me just add a line in here, certainly the 2110 high we had back at the start of November, the November high is of course important, and I guess the trend line's close enough to that. But to continue the pattern of lower highs, we can't have the S&P up above 2110. So I think you know, today's session and indeed the big events ahead of us over the next 3 days are really key from a technical point of view. Of course, the fundamentals will drive direction, and if the fundamentals play out in a way that drives the S&P higher, then technically that's really significant, because a break of 2110 could well just be the catalyst for this index to test the all-time high set back in May. But of course, lots of events ahead of us that will determine whether there is any more upside for this market or not. The reason why we climbed yesterday, as I said, it wasn't because of good news. It was, of course, because of bad news. So, and you know, just thinking about the Fed and so on, I just want to show you here the chart. So on the data front of the US yesterday, the ISM manufacturing data was delivered, and it came in below 50. And it's the first time below 50 for this reading since 2012. This is the manufacturing sector in contractionary territory. You know, loads of stats flying around, given the fact the Fed are expected to hike rates, and how, you know, if they do begin their hiking cycle in 2 weeks, it will be a record low ISM manufacturing number as a hiking cycle begins. The last time they hiked rates with ISM manufacturing below 50 was back in the 1980s. So, you know, really bad news, properly bad news, this. And actually, the FT were pointing out this morning that yesterday, for the first time since February 2009, which was basically the pinnacle of the financial crisis, for the first time since that month, we've had the two world's biggest economies have their manufacturing PMIs in negative territory, because China are below 50, the US is below 50. However, and that maybe let me show you this chart on a 5-year time frame, because this is, you know, where we hit. And actually, let's go 10 years. So where we hit yesterday is basically a new 5-year low. I mean, we're testing this low we had in 2012, which officially was a touch lower, but basically it's the lowest we've been since the crisis. That's pretty much the bottom line. However, does this mean the Fed are going to say, hang on, hold up, the economy's lost momentum, we're not going to hike? Is that what's going to happen here? And it was interesting to see that Fed rate hike expectations hardly changed yesterday. So they still remain up in the 70s. I think it's 72% or something. So why is this not necessarily that important? It's because of this chart. This is the ISM non-manufacturing, and I have to say this data tomorrow actually becomes hugely significant, because it's fine for manufacturing to be weak, but only if services stay strong. So we're going to get the ISM non-manufacturing data tomorrow. It's up at 59 in October. You know, we want to see this strength continue. Let me show you this on a 5-year chart, and you can see it's trending higher. So we do have a very strong services sector, a strong, very well entrenched, improving trend in services, which makes up 85% of the economy, by the way. So this is miles and miles the more important of the two ISM readings. And if you look at this on a 10-year chart, basically for non-manufacturing, for services, this is about as good as it gets. Let's go on a max. Actually, how far can we go back? No, we can go back to the 90s here. Look, this is basically as good as it gets. Up around 60. Very, very rarely do you get an ISM reading above 60. So services really strong, really solid, which is why the manufacturing number becomes less important. And actually, the divergence between the two is at a record. There's a record large gap. The divergence between non-manufacturing and manufacturing has never been this big. Yeah, just looking at rate hike expectations there. Anthony posting this graphic from the FT. And so we've got the expectation that 74% probability that we're going to get a rate hike in 2 weeks' time. And then you can see the probabilities as they go right. There's 9% of people expecting a second rate hike in the January meeting. But actually, you've got to go all the way down to June. So as it stands, and we'll talk much more about this in I think this week it's ECB week. Let's just give them their moment in the spotlight. It will quickly become the Fed, of course. But one big topic of conversation in the next 2 weeks isn't necessarily will they hike. It's how quick are they going to hike through the cycle. And at the moment, we're pricing in the second hike in June, which I think, well, I'd say that's dovish. That's even though this is the majority, I'd say I would say the Fed would want to guide us that they're perhaps going to hike rates for a second time before June. I mean, are they going to wait 6 months for hike number 2? If they're hiking one hike every 6 months, 0.25% each 6 months, I mean, it's going to take them years to get any kind of sort of interest rate ammunition back. So I think they're going to want to hike faster than this. So perhaps the market is priced too dovishly when it comes to the trajectory of the hiking cycle. But anyway, that's for focus, I guess. I guess it is in focus today because we've got Yellen talking, but that'll be the main focus when the run up to the Fed meeting. So yeah, the data yesterday for the US was bad, but it's not necessarily all that important as long as and only if the ISM non-manufacturing data that's delivered tomorrow comes in nice and solid. Flip to Europe. And Europe, we saw generally the manufacturing PMI is getting better. We actually saw the unemployment rate drop to a new multi-year low. Europe's really strong data-wise, and all of a sudden the US is weak. And so we got this divergence yesterday. S&P moving higher, I guess because of this sort of perverse almost behavior where bad news is good news, because maybe the Fed aren't going to hike rates. Whereas in Europe, it was the opposite. Good news means bad news because perhaps there's less chance that the ECB are going to deliver the full package of treats that the market wants tomorrow. So interesting day. We had a dollar profit taking was the feature session with euro dollar and a strong euro because of the strong data in Europe, slightly reducing the chances of stimulus from the ECB. So we had a decent move on the euro dollar. If you look on the daily chart, though, we're still right at the bottom. We're still very much in the downtrend. And so certainly no technical reversals on this trend, even though yesterday's session was reasonably bullish, or certainly relatively bullish. For bond markets, it was an interesting day. Big move higher on T-notes. Big sort of reversal. If we just go to a 1 hour chart on the Bund, big reversal off the opening weakness, big breakouts of the downside on the Bund in the morning, and then that just got all reversed, and T-notes dragging the Bund upwards in a powerful sort of afternoon session as yields dropped. This morning we've got pullbacks on this. It doesn't make too much sense, I wouldn't say, this move. Maybe some of it was safe haven flow because of the various different sort of terrorist risk events yesterday. But when you've got equities selling off because of good data, so reduced expectation of the ECB acting, well then, really you should get the Bund selling off as well. And that's what happened in the morning, but of course it got entirely reversed. So a bit of an odd session, I have to say, yesterday for the bond markets. We'll see if they kind of behave themselves this morning. But it seems to be a bit more logical, this morning's sort of weakness, giving back those gains from yesterday afternoon that were perhaps a little bit odd. Then just looking at oil. So, yesterday was an important day, testing the double bottom from the 16th and the 18th of November at 41.20, and but it does look vulnerable here. I know we tested that support and it held and we banked, but I just feels heavy, and so for any break of the 41 handle is important, as really it sets up what almost certainly would be a drive to test the August low, which for the January contract is at $40. So we've got oil inventories today. We had the API deliver numbers last night that showed another build in stockpiles. I think, what was it, 1.6 million. So we've got an expectation of 900,000 for today. So we shall see. I guess the other thing that helps, I'm just thinking now, if we just turn to the data calendar, we do have a lot of Fed speak today. One thing that might have helped with that movement on the S&P might have... Evans spoke. He is dovish, so it's not really surprising what he said. He said that... hang on, let me get this right. So he admitted to some nervousness about the upcoming FOMC decision. And he highlighted that he would prefer to have more confidence than I do today that inflation is indeed beginning to head higher. That's not a man who wants to hike rates, except that he's probably in the minority. So we're probably going to get a rate hike. Evans is dovish, so that's a typical comment from him. But maybe it kind of helped with that bounce on US equities yesterday off the idea that maybe they're going to bottle it. They're going to blink and actually not hike rates in a couple of weeks. We have Brainard talking yesterday as well. Brainard was relatively cautious and really preferring to focus on not are they going to hike, but saying the new normal for the US economy is likely to be characterized by a lower level of interest rates than in the decades preceding the crisis. So, talking about the gradual approach to adjusting monetary policy. So that's talking about the rate hiking trajectory through the cycle. Anyway, look at the calendar for today. Sorry, let me just move. Well, yeah, let's look at the Fed speakers at the bottom here. So there's a big event today. Yellen's, of course, topping the bill. She's making some comments at 1:30, but it looks like they're not going to be particularly interesting. We'll have to wait and see. But she's just delivering some welcoming remarks at the beginning of this event. Then you're getting Tarullo speak at 2, and Yellen is expected to kind of speak in much more detail at 5 or even 5:25. So it's a bit uncertain when we're going to get comments from Yellen that might be important, but it's most likely going to be after the European close. We then get Fed's Williams as well. We've got Lockhart, before Yellen at 1:10. So lots of Fed speak to look out for. And this is really the final week where they can say anything before the media blackout ahead of the meeting on the 16th of December. I'm just looking at the data then. This morning we do have some European CPI numbers at 10 o'clock. Before that, construction PMI from the UK at 9:30. Just on this European inflation data, this is the final reading for November. We've already had the sort of preliminary reading. We're expecting year-on-year CPI to tick up to 0.2%. Have a look at the chart here. That would be a 4-month high, and pretty much the highest of the year. I know we had a plus 0.3% read, but it's again reassuring. It's odd how European data is just suddenly. Well, I guess it's not odd. Maybe this is evidence QE is working, for example. But the data's been really solid out of Europe. I was reading an article in the FT this morning, just talking about how such are the dramatic moves in exchange rates post-crisis, because of the aggressive nature of monetary policy, and because of the dramatic moves in the exchange rates. So let me just show you. If you looked at a monthly chart on euro-dollar, the dramatic swings we've seen, and certainly this one, end of 2014 and into 2015 being the most significant. This has meant that Europe are now seeing the benefits of a cheap currency at the expense of the US. So actually now you're seeing good data and what looks to be quite a positive outlook from a growth perspective for Europe into 2016. And you get the exact opposite in the US, where it's all of a sudden looking a little bit fragile. And they're just talking about, is it Europe's turn? Have they been passed the growth baton? The US have been growing for years. Europe hasn't. So is it Europe's turn? And then, the irony is that, here we are in a month where we're expecting aggressive easing from the ECB and the Fed to hike rates for the first time in a decade. And yet, it's Europe's economy that's looking the most positive from the sort of trends in the data. And it's the US economy that's looking less positive. So if this inflation number comes in at 0.3%, for example, that'll be significant. It matches the highest we've had for more, for 12 months. 0.4%, well, that would be a huge event. It won't. It's unlikely this data probably isn't going to be revised particularly much, but let's just say it was. If it got up to 0.4%, I think that would be significant. I think you'd get a notable change in expectation as to what the ECB are going to do tomorrow. But most likely it'll be in line at around about plus 0.2%, which does continue this little bounce we've had off this brief dip back into deflation that we had in September. Then this afternoon, obviously we'll talk about this nearer the time, but ADP employment is an important one. Ahead of payrolls on Friday, this is private sector job creation. We're expecting 190,000, a touch above last month. I mean, this, I would say, given what happened last month, makes this data today less important, because the ADP number came in at 182,000, and then payrolls came in 272,000. The point being that this was a rubbish lead indicator last month. So that means, does this number really matter today, given that it's not a good guide to what we're going to get on Friday? So, and because we've got so many Fed speakers, I would actually say the ADP number perhaps isn't really going to get much attention. But of course, we'll cover it as we come through. It's the kind of big macro data of the day from the US. We do have then the oil inventory numbers, of course, at 3:30. Sorry. So just on oil, we're 2 days away from the OPEC meeting now, and as I said, oil's looking a little bit vulnerable. It just feels vulnerable. I know we haven't broken the $41 handle, but feels like we might. And we'll see what we get on the data. But there's another interesting article in the FT this morning, just talking long term for crude, talking about demand. Check out this chart. I think this is the most interesting chart I found in the FT today. Looking at long term, this is looking at net. Well, it says net exports, so it's all negative, which means net imports, but just showing that all the demand growth in oil ahead of us, let's say over the next 20 years, most of the demand growth is just, in fact, 60% of global demand growth in the next 20 years is expected to be from two countries, India and China. And the US is expected at this point to be self-sufficient in about 15 years' time. That means they will not have to import any oil whatsoever. And, this will be a game changer, to say the very least, when it comes to thinking about things like foreign policy and which country is most interested in stability in the Middle East. And it's going to be not the US anymore. It might switch to China. Anyway, quite an interesting chart, I thought. But, these forecasts are 20 years out, so it's pretty tough to judge. Certainly with this US one, are they going to be self-sufficient? A lot of that is going to depend on what happens with the price of oil, of course, and whether the shale process is going to be able to grow as it has done in recent years. Anyway, that's more of a thought for the long term. So let's get on with the session. What we have here right now is we've got crude just down, tested. Well, I guess it's been a very, very, very tight range, it has to be said, for crude so far today. But 41.50 is of interest, and that's really where we've bounced off this morning. So far, that's been the support. That was the low we had on the 30th. The double bottom, the key double bottom on the 30th of November. That price point has been weakened because we chopped through it. A real messy session yesterday, yo-yoing up and down between $41 and $42. So quiet so far for crude as we get the session up and running. The Bund has given back some of yesterday's afternoon's slightly odd rally. US equities are right up on this really important top, and think about the long-term downward trend line. Think about the November high at 21.10. Europe again looks like it's ready for more downside, it has to be said. I think I'd say downside bias on European equities again, but don't necessarily think that means the US stocks are going to follow, because we've got an inverse correlation at the moment. Okay, let's get on with it.